BTC falls -21% and ETH -32% over a short window, while institutions treat both as part of a risky satellite allocation. Which risk metric is most useful for deciding position size in such a crypto sleeve within a larger portfolio? Your options are: A. Simple average daily return over the last month, ignoring tail events. B. Nominal traded volume in dollars across exchanges, without linking to price risk. C. Rolling tracking error versus a 60/40 equity bond benchmark portfolio. D. Historical maximum drawdown for BTC and ETH combined with forward-looking stress tests. And the correct answer is option D. Historical maximum drawdown for BTC and ETH combined with forward-looking stress tests. Institutions are using spot Bitcoin ETFs and then booking profits through ETF redemptions, rather than only trading on unregulated exchanges. From a product strategy perspective, what key advantage do spot ETFs offer to such investors? Your options are: A. Complete elimination of price volatility, regardless of Bitcoin movements. B. Access to BTC exposure via familiar securities infrastructure, with standard custody, reporting and mandate fit. C. Guaranteed outperformance relative to direct BTC purchases on every time horizon. D. Full exemption from any risk and compliance checks within the institution. And the correct answer is option B. Access to BTC exposure via familiar securities infrastructure, with standard custody, reporting and mandate fit. Flows show that large financial institutions reduce BTC and ETH exposure when macros are volatile but do not exit structurally. How should an investment policy statement, IPS, most prudently classify such assets? Your options are: A. Core defensive holdings alongside government bonds and money market funds. B. Liability matching assets designed to replicate future pension payouts. C. Opportunistic or satellite growth assets with explicit risk budgets and concentration limits. D. Operational cash equivalents treated like overnight deposits. And the correct answer is option C. Opportunistic or satellite growth assets with explicit risk budgets and concentration limits. BTC and ETH make new highs, institutions take profits, and then prices correct sharply. Which behavioral or trading pattern best fits this sequence for short-term players? Your options are: A. Disposition effect, holding winners too long and selling losers too early, regardless of valuation. B. Momentum chasing, selling rising assets and buying falling ones against the prevailing trend. C. Profit taking into strength, systematically scaling out when prices approach or breach prior highs. D. Anchoring to original purchase price, refusing to sell as long as prices remain above entry levels. And the correct answer is option C. Profit taking into strength, systematically scaling out when prices approach or breach prior highs. Despite volatility, BTC and ETH continue to attract institutional interest, are wrapped into ETFs, and are monitored via liquidity and macro cues. Strategically, how are these assets best viewed within the evolving financial ecosystem? Your options are: A. Complete substitutes for sovereign currencies that immediately replace central bank money. B. Narrow, permissioned instruments usable only within small private consortia. C. One of several speculative growth and alternative risk buckets competing for risk capital and fee pools. D. Purely experimental test tokens with no relevance for mainstream capital markets. And the correct answer is option C. One of several speculative growth and alternative risk buckets competing for risk capital and fee pools. BTC falls -21% and ETH -32% over 2 months amid tightening liquidity, ETF outflows and support breaches. For a risk team building forward-looking stress tests on a crypto sleeve, which design is most appropriate? Your options are: A. Only replay the exact historical path of the last 2 months and assume it cannot be worse. B. Embed multi-factor shocks combining liquidity tightening, 30–40% price drops and forced liquidations from leverage. C. Use a flat 5% move up or down as the sole price shock in all scenarios. D. Assume BTC and ETH always recover fully within 1 week and cap maximum loss at 10%. And the correct answer is option B. Embed multi-factor shocks combining liquidity tightening, 30–40% price drops and forced liquidations from leverage. Institutional flows suggest BTC and ETH are cut when global risk sentiment soars, even though fundamentals are said to be intact. In a cross-asset strategy framework, which classification best captures their behavior? Your options are: A. Structural diversifiers with stable negative correlation to global equities across all regimes. B. Equity-like high beta exposures whose correlation to risk assets tends to spike in stress periods. C. Perfect substitutes for investment-grade credit with similar spread dynamics. D. Purely idiosyncratic assets with zero correlation to any macro factor or equity index. And the correct answer is option B. Equity-like high beta exposures whose correlation to risk assets tends to spike in stress periods. A corporate treasury is considering adding BTC after seeing both sharp rallies and deep drawdowns, along with evidence of institutional profit booking and rebalancing. Which treasury policy stance is most defensible? Your options are: A. Treat BTC as a core cash equivalent reserve, usable for near-term payroll and supplier payments. B. Prohibit any BTC exposure under treasury policy because audited fair value cannot be disclosed. C. Allow a capped, non-core allocation under other financial assets with strict drawdown and liquidity limits. D. Mandate BTC as the primary functional currency for financial reporting and taxation. And the correct answer is option C. Allow a capped, non-core allocation under other financial assets with strict drawdown and liquidity limits. An asset manager running a crypto fund must explain the recent BTC and ETH drawdowns plus ETF outflows to sophisticated clients. Which fact sheet framing is most appropriate from a professional communication standpoint? Your options are A. Present drawdowns, volatility, maximum loss periods and flow data, alongside the long-term thesis and risk limits. B. Omit all references to downside moves and show only long-term cumulative return charts. C. Blame retail traders entirely and state that institutions never change their positions. D. Guarantee that such drawdowns will not recur once blue chip status is reached. And the correct answer is option A. Present drawdowns, volatility, maximum loss periods and flow data, alongside the long-term thesis and risk limits. Given that BTC and ETH have large swings influenced by macros, leverage and technical levels, which new product idea most intelligently uses this volatility rather than simply suffering from it? Your options are A. A capital protected note with upside linked to BTC, hedged with options and capped downside at principal. B. A naked long-only leveraged ETN with no risk disclosures and unlimited downside. C. A. Zero-risk BTC fund marketed as guaranteed principal plus unlimited upside with no hedge structure. D. An ETF that promises flat returns regardless of BTC's price, without any derivatives or hedging. And the correct answer is option A. A capital protected note with upside linked to BTC, hedged with options and capped downside at principal.